So the first company to present today is Shanta Gold. Shanta is a low-cost, high-grade East African gold miner, which is transforming from a single asset to a multi-asset producer. Sales in calendar 2019 were $113 million. The market cap is £173 million. Its largest shareholder is OD Asset Management, which has got just under 18%. And we're very pleased today to be joined by two speakers, the CEO, Eric Zurin, and the CFO, Luke Leslie. Eric, over to you.
That's great. Thank you very much. I'm assuming you can hear me okay, and looking forward to taking you through the story of Shanta over the next 20 minutes. Before I begin into the slides, it's worth just laying out who we are and what we do, because we've had a long history on the AIM market. Shanta has been listed in London since 2005. That's 15 years. And as a company, we've been producing gold for the last 8 years. We've produced and sold just under $1 billion of gold over our history. We're profitable. A lot of mining companies can't say that despite the commodity prices. And at the moment, we have now 3 assets in 2 countries with over 3 million ounces of gold contained in the ground. Now, for us, what's really interesting is we've now transitioned from a value-only story to a value and a growth story. And we'll take you through what that actually means and the reasons why we think it's particularly interesting to be looking at Shanta now. But remember this, at the current gold price, we're generating about $100 million US of EBITDA, which has us trading on about 1.7 times EBITDA. Our balance sheet is pristine. We have a net cash balance of about $35 million. By the end of the year, we'll be unhedged. And I would argue you'll be hard pressed to find a company as attractive on similar fundamentals and valuation. So what does the next few years hold? Well, let's start off on slide 3 to introduce myself and Luke, who will be speaking in a few minutes. We've been working together for the last, I believe, the last 13 years in different capacities since initially joining at UBS in London, UBS Investment Bank. We're supported by a very strong board who have experience across Deloitte, also at UBS, Rio Tinto on the technical side. And collectively, board and management own just over 7% of the company, which for me is very important because that aligns all of our interests. And as you'll hear later, Shanta is my single biggest personal investment. Now, if you go on to slide 4 of the presentation, and then on to slide 5, you can see here that we have 3 assets in 2 countries. We produce gold from our main asset called New LUIKA Gold Mine in Tanzania, where we've been operating for 20 years in the Republic. We have a multitude of catalysts over these 2 assets that demonstrate well over $600 million of NPV, despite our market cap being around about $200 million at today's share price. And as I said earlier, our portfolio delivers value and it delivers growth, whereas previously we were simply just a deleveraging story. Now, if you look at our portfolio on slide 5, you can see here the New LUIKA Gold Mine is the one that has generated all of our cash historically and will do for a little bit more time. But it is that asset that's in this cash harvesting period, which has allowed us the flexibility to pursue other options and the growth in our portfolio. New LUIKA is an underground gold producer. We will mine about 80 to 85,000 ounces of gold from this asset this year. It's low cost, high grade, and it's through an underground, predominantly underground mining method called long hole open stoping, which has a common link with the asset we've just acquired, West Kenya. Now, the West Kenya asset is one that we bought from Barrick. Barrick's the second largest gold company in the world. This was far too small for them. They acquired it from an M&A process that left this one as a non-core asset. Now, the good news about West Kenya is it's very well invested for what we've acquired. We've paid $14 million for this asset, which is roughly about 20 cents on the dollar versus what has been invested so far at this asset. But the headline grabbing number at West Kenya is the fact that it has 1.2 million ounces grading 12.6 grams per ton. And that is by far, as we understand, one of the highest grading, if not the highest grading, plus 1 million ounce deposit in all of Africa. We recently raised equity, and that was very deliberate, to invest directly into the West Kenya project. We'll take you through the merits of why we did that, why we think the reward of taking the reason for taking permanent capital today was far outweighed by the reward of the potential prize at West Kenya, and we'll take you through the reasons for that. Now, the third project we have in the portfolio as part of our growth is the Singida asset. It's one we've owned for about 10 years. It's a complementary add-on in terms of gold production in Tanzania, and this will take us up to 100 to 115,000 ounces of gold production in 2022. And at today's gold price, that would be over $200 million of revenue. If you go on to slide 3, now this really points to what Luke and I have been up to over the last 3 years since we took the current roles at Shanta. It's been a track record of delivering production and deleveraging the balance sheet over that period. And remember, that was at a much lower gold price. So you can see on the left-hand side of the page, we've taken the share of debt or of enterprise value. So this is net debt and market cap. And so we've taken the share of market cap to total enterprise value was 42%, which basically means the shareholders own 42% of the assets. To where it is today, it's well over 100%. So we basically have more cash than we have debt. And that was through very hard deleveraging, very hard decisions, cost control, capital management, and very disciplined production. What that's translated to on the right-hand side of slide 6 is a clear outperformance against our peers. We're up nearly 5 times from where we were 3 years ago, far better than our peers, and I think about 10 times better than the gold price. So overall, hugely rewarding. But if you look to slide 7 and you consider what's next, how do we take the share price up yet again beyond where we've taken it to at the current price? A lot of catalysts, and the catalysts come from the growth portfolio, or the growth in the portfolio. And I cast your attention to the West Kenya project, which we just acquired. As I said, this is Africa's highest grading plus 1 million ounce deposit understood across the continent. We have acquired it for about $12 an ounce. We think it's worth a lot more per ounce if we can deliver on demonstrable value at that project. And what does that mean? It means we have to infill drill. We have to put more holes into the ground to prove that with higher confidence there is economically statistical gold to be mined. And so this really is core to our value proposition, to the equity story, which is this growth lever that we want to deliver, and what we will be delivering on between now and the next 36 months. On to slide 8. You can see here on the value side of the story. So we've talked about the growth, which is West Kenya and Singida. A lot of growth to be had, more than doubling our production. We now have the value side of the story, which is our producing asset. Shanta's invested historically about $250 million into this asset, which means it's well invested and it's in a cash harvesting period. We often get the question, what are we going to do with the cash? Well, we're investing it into the Singida asset, which is now fully funded into production. And we've also committed now to a dividend. And that dividend will be paid in April. The board is conscious of having to declare a dividend policy. And I can put it in context. In the last year, I think we repaid about $20 million of debt against our market cap today of about 200 million. And so we'll be deploying some of our surplus cash as return of capital to shareholders. So there will be a dividend at Shanta in 2021. Make no mistake. On to slide 9, which is speaks to how we operate in Africa. It's a very particular place to be successful. As I said, Shanta's been operating in East Africa for 20 years. I've been traveling back and forth to Africa for the last 7 years on a dedicated basis. And what's most important to us in Africa is maintaining our social license to operate. What that actually means is having the community and the host government wanting us to be successful in the country. Shanta has often been regarded as the showcase mining company in Tanzania. There have been some incredible headlines with our larger peer Acacia over the years, which hasn't fared so well. Shanta's been incredibly successful in Tanzania and will continue to be so. We have a very specific approach to operating in Africa where the host government must benefit and as I said, the communities must be beneficiaries of our presence. On to slide 10, and then I'll hand over to Luke to take us through some of the catalysts. But effectively on slide 10, what you see here is the value proposition. You know, for the generalist investor, what does Shanta really boil down to? Well, on one side of the equation, you have our market cap, which today is about $200 million. No debt. We have just over $40 million of cash on our balance sheet. That cash is to be used to accelerate our growth. And the risk profile of the company is very attractive. Now, on the right-hand side, you have our 3 assets. And for a generalist investor, we often get the question, what are the assets worth? Well, the new LUIKA gold mine, the one that's producing, this is the value asset, we think is could arguably be worth the market cap. You know, it's generating $100 million of cash flow per year. That works out to about $50 million of free cash flow per year. And that's very attractive. Now, the other assets, Singida and West Kenya, which are the growth side of the portfolio, we've published net present values at $1,700 a gold price per ounce, and that's 56 million at Singida and 340 million at West Kenya. So overall, we think there's about at least $600 million of value to play for against our market cap of about 200 million, with we would argue very little risk and a lot of potential. Now, what I'll do is I'm going to ask Luke to take us through the value drivers. This is starting on page 11. How are we going to demonstrate all of this value in our portfolio? What's really important for shareholders to focus on? And when can they expect to see some of the results? And so, Luke, if you don't mind, over to you.
Thank you, Eric. Okay, so over these coming slides, I'm going to talk to you, as Eric said, about the upcoming value catalysts, but also the investment proposition that we think the market is still to understand. So I'll start off here on slide 12. And this is the new LUIKA gold mine. So Eric's already spoken a bit about this. Each year of mine life generates an additional $50 million of free cash flow. And on this slide, what you can see is our track record in delivering that additional mine life. So each year when we explore, we replace the ounces that we've mined. Now, typically, we haven't spent a lot of money on exploration. We find that a relatively small amount allows us to extend and replace that mine, the ounces that we've mined. This year, we've already replaced 105,000 ounces, and we still have 3 rigs turning at New LUIKA. Next year, we'll be spending $7 million. And I think it's, I can say that we're getting some encouraging results, including at a new target called Porcupine South, and we'll be updating the market over the coming months on the ongoing exploration work at New LUIKA. Just turning now to slide 13. Now, there's a lot of data in this on this page, but there's two key value catalysts at Singida. Singida is our second mine. We announced that we started construction. We've completed some of the initial spend there, and we've committed to a first gold pour at the end of 2022. So far, on the basis of the internal DFS, we're assuming a mine plan based on less than 30% of the resources. And this is the second material value catalyst at Singida. The geology points to this reserve being much bigger. And we've committed $1 million to spend in Q1 next year, and we look forward to updating the market on what the reserve is likely to increase to. I'll just move ahead now to slide 15. And this is the new project that we acquired off Barrick. This is the West Kenya project. It's a very, very significant acquisition. We will be drilling, so in 3 phases. We're looking to convert into reserves 786,000 ounces. Now, when you look at the comps, we acquired this project for $12 an ounce. You look at the comps for high-grade projects like this, and they're valued around $300 an ounce. So that's the rationale for the equity raise. We're looking to convert those ounces in the next couple of years. Within 3 years, we'll have a DFS. I'll just finish off one more slide here very briefly, and Eric will just wrap up. Slide 16. Here you can see a number of upside targets in and around the Azuli and Bushi and Ngada resource. We remain of the view, as Acacia did, that there is 3 million ounces for us to discover in and around the existing resources. With that, I'll pass back to Eric to conclude.
Thanks, Luke. In conclusion, our value proposition really is around the value we generate in our cash flows, $100 million per year, plus the growth we can demonstrate in our portfolio, both at Singida and West Kenya. Added to that, there'll be a dividend in April. We're fully funded for the next few years to fund the Singida construction and the West Kenya growth. And frankly, we have cash flows to build both of those through to about over 200,000 ounces of production per year over the next few years. So a lot to look forward to across the portfolio, a lot of value to demonstrate, and the growth is really exciting. With that, I'll conclude and take any questions. Thank you.
Going to move straight into questions now. The first question is, what should shareholders be concerned about political risk?
Yes, well, I mean, political risk is prevalent across the world. You can see it in all sorts of countries, including the Western world. Now, the way to mitigate political risk is through strong stakeholder engagement. Now, what does that actually mean? It means you pay your taxes on time, you employ locally, and the communities benefit. Now, it's not rocket science. You have to be well liked in these places, and the people who you're working with need to benefit. You would be amazed at the number of companies that just don't follow those 3 simple principles and suffer the consequences. And we think we have a strategy in place to do that. We've been operating in Tanzania for 20 years. We've shipped 205 times to Switzerland our gold, and we think we're in a really good position.
Thank you. A second question. Your company's stock has done well over the last 3 years. You're obviously changing your strategy, as you mentioned, from being value to value and growth. What can you tell us about how your shareholder base has changed over that time, and how do you think it might change in the future?
It's been really interesting. I mean, in October, we raised just over $40 million to fund West Kenya. As I said, the downside of permanent capital was far outweighed by the size of the prize at West Kenya. They talked about being $300 an ounce of value, and the interest we had across the world was phenomenal. I mean, we had 50 meetings in a matter of 4 days. A lot of interest out of North America. A lot of groups who were keen who saw the value and couldn't quite put a finger on the growth, but could see that there was something pretty interesting. We've been institutionalized over the last month, and I continue to think that the story, fundamentally is very strong and will attract the right investors.
The next question is: have you received a lot more interest from the brokerage community? And what have you been doing in your investor engagement activities to narrow the gap between EV and NPV?
Yeah, good question. So we've had a lot of groups who, obviously, the better you do, the more interest you generate, and that's from all of the different groups, particularly in London, looking for advisory roles. In terms of investor engagement, it's as frustrating as it is. Us trading at we think 0.3, 0.4 times net present value. The share price has gone up 500% over the last 3 years. And we'll continue doing what we're doing, which is demonstrating the growth and pitching the value. It's a pretty simple story. A lot of cash flow we generate, a lot of growth on the other side, and a pristine balance sheet. So it will come good. It's just a matter of time.
Okay, so the next question is a request for more information about your dividend policy. You very quickly mentioned that in the presentation, but we've been asked for more information. If you can provide it, please.
Yeah, so we've committed to paying a dividend. We don't have a policy yet. We have some ideas around it, and a figure to be determined. That'll come in the new year once the board's properly considered the policy and what to commit to investors.
So the drivers for cost could the rising price of oil, for example, rising price of gold, tend to be inflation sponsored movements. How do you contain your OPEX in a world where gold price may be rising, but so will the price of oil?
Great question. Yeah. So just this month, we're currently 14% of our power comes from the grid, which is clean energy. It's half the cost of fossil fuels. And that number will go up to, I think, just under 40% of our power needs in the next 3 months, I would say, will come from the state grid, so electricity, as opposed to burning oil. And so that's, for us, one of the key mitigants. We don't hedge oil. We don't want to take a view on oil. We think it's naturally hedged against the gold price anyway. But as I said, the sooner we can get off the fossil fuels, the better.
Okay, the next question is, could you please summarize the catalyst for the next 3 to 6 months? I think you mentioned quite a lot, so maybe you could just repeat them for the benefit of the audience.
Yeah, why don't I mention two catalysts from each asset. So at New LUIKA, the clear catalyst there will be reserve additions and any exploration upside. And Luke's mentioned Porcupine South as a regional target that we're exploring. We have 3 rigs permanently drilling across the mining licenses and the region. A lot to look forward to there at New LUIKA. At Singida, that is moving into construction, and the team's been deployed. The real story at Singida is we will be drilling shortly the reserve extension, and that is a catalyst over the next 3 months, whether we can do some infill drilling to increase the reserves. And then West Kenya, the drilling will commence in the next few weeks. We've now determined the contractor. The rig is being mobilized from northern Tanzania, and that will be drilling 9,000 meters over the next 3 to 4 months across the oxide. So there will be drilling results out of West Kenya, and hopefully there'll be resource upgrades.